So now this is relatively a larger reading, but even bigger chunk of theory areas to be mastered. Okay. So we'll go step by step, and I'll make you write down as much as possible so that you remember the most. So first point of discussion is the role of equities in overall portfolio. So you had almost similar point of discussion in the level 1 equity syllabus. Okay. Now the idea is this, they're simply asking you, are equities important from the portfolio management perspective? And can you imagine the answer? Of course, yes. Now what additions they have done at level 3 is they've given you certain factual data. Okay, so they've said that almost 50% of the US institutional investors, US institutional investors will have 50% of their holdings in equity. Okay, European institutional investors will typically have 25% of the holdings in equity, but on an average, equities have done really good. They have been an excellent inflation hedge, and therefore they are an important part of overall portfolio management process. So certain factual data would be useful. So what you can simply write down is US equity contribution 50% of the world's equity. Okay, and it's kind of a staggering number because the entire world's equity 50% is in one single country, and that's why maybe our economy is so much dependent on what's happening in US. US institutional investors typically have 50% of holding in equity. European counterparts will have 25%. You don't have to remember the exact numbers. What you need to remember is that generally US institutional investors will have larger holding in equity as against the European counterparts. This is important. Equities have had consistently positive real returns. What does the word real mean? After beating the inflation, and higher real returns, positive and higher real returns in 17 countries over 106 years. Okay, so what they have done is they have given reference to some research paper published by a professor, and this is the research conclusion that is derived. It says 106 years in 17 countries positive return, so must be most of them European. Equities are good inflation hedge, especially when firms can pass on the inflation to the consumers. Bonds are not. So this point maybe you can write down. This would be helpful. Write down. Equities are good inflation hedge. Equities are good inflation hedge if firm has the ability to pass on the inflation to the customers. Are we fine with this? And of course this is directly related to what we have studied in level 1 economics, the price elasticity of that particular product. Right, so if the product is highly elastic, then the ability to pass would be lesser, very less. But if the product is inelastic, then the ability to pass on would be relatively higher. So there are few questions like these, we'll be seeing them. It says bonds are not a good inflation hedge. Can you tell me why? Yes, the returns are fixed, and with a higher inflation environment, the absolute value of that interest or coupon payment decreases. Try to answer the question. I think it's too easy. Yes, is the answer. Next one. Yes, C should be fine. A and 2 both are factually incorrect. Next point of discussion, rationals and rationals for these type of investment and distinguish between passive, active and semi-active, which is enhanced indexing. Okay, so again similar to what we saw in fixed income portfolio management, except that the number of questions you will get on identification here would be lesser. Okay, there are only 3. So again, these are not 3 discrete, but these are more of on a continuation pattern. Passive means your belief is that markets are efficient and therefore there is no added benefit of investing into fundamental research. Active means your belief is that markets are inefficient and then you want to beat the index by picking either right sectors or either using tactical allocation strategies. Semi-active is somewhere between the two. So maybe you will have the composition of index, but either you would cut down on number of securities or maybe you would take positions based on few specific sectors on few specific times. No. Satellite was something else. Satellite portfolio was where let's say you have 100 rupees. Out of that 90 you invest based on the portfolio mandate, typically into safe securities. And then the remaining 10 you invest into risky portfolio so that you can earn excess return. That was a satellite portfolio. This is not that. So passive, active and semi-active or enhanced indexing strategy. Now this discussion is restricted to active return and tracking risk. What is active return? Yes, the alphas that we have been able to earn, excess of returns over the index. And tracking risk would be the standard deviation of active returns. That means standard deviation of those excess alphas that we have been able to earn. Now, can I say that passive will have lowest amount of active return and risk both? Active return and lowest amount of active risk. And can I say active portfolio strategy will have highest of both of these? And then semi-active would lie somewhere in between. Have we also learned that there is something called as information ratio? So now see what is information ratio. How do we calculate? Active return divided by active risk. Now in case of passive, it would be low active return and almost close to zero active risk. So information ratio should be lesser or closer to 0. In case of active, you will have high amount of active return and you will also have high amount of active risk. Okay. In case of semi-active, which is also called enhanced indexing, you will have moderate amount of active return, you will have moderate amount of active risk. So now out of these two, which one will have higher information ratio? Active? The answer is depends. I mean, we cannot make a comment based on this because we need to have actual numbers, but they have done an empirical research on this, and what they have found is that the best information ratio is actually of semi-active, then of active, and of course the lowest would be for passive. Is it fine? That means what conclusion they have made at the end of this LOS is that active return has not necessarily done better than the semi-active portfolio managers. And that's it. If you know this, this LOS should be fine. Let's see this. Passive managers do not allocate resources for research and forecast. Passive managers do not attempt to outperform index by deviating from index constitution. Common passive implementation strategy is indexing. Indexing is simply replicating the index or mimicking the performance. Active managers buy, sell and hold securities in attempt to outperform their benchmark. Even with the growth of indexing, active management still constitute vast majority of assets under the management. This is again empirical data. Nothing on the slide is to be written. Semi-active managers attempt to earn a higher return than the benchmark while minimizing the risk of deviating from the benchmark. How we find? So this is between the two, active and the passive. Active return, we know what it is. We know what is tracking risk. We look at information ratio, empirical data. Highest for semi-active, lowest for passive, and active management falling in the middle. Active return and risk empirical data, highest for active, lowest for passive, semi-active falling in the middle. Okay, so this section I want you to write down. Everything else should be fine. Are we good to go ahead? Alright, let's see if we can solve few questions on this. Highest information ratio. Yes, this is nothing but semi-active. Okay. Next one. Highest expected active return. This should be active. Lowest expected active risk. Pure indexing, which is passive strategy. Alright, next point of discussion. Recommendation of investment approach given IPS and market efficiency beliefs. Okay, that means if you have belief of a client that what he feels about market efficiency, then what approach will you recommend him? Passive, active or semi-active? And which is straightforward. If he feels it's efficient, then passive. If he feels it's inefficient, then active. And then if he is between the two, semi-strong, then we will say pure the enhanced indexing, which is semi-active. Also the given IPS data. So for example, let us say an investor is in the tax bracket. He's got a larger amount of tax on profit to be paid. Then will you recommend him active or passive? You would recommend him passive, because in active the turnover would be very high, isn't it? No. So let's say there is one client which is a trust, which is got tax-free income. None of the income is taxable. One client which has got a taxable income. So then the one which is got no tax payment to be made, you would recommend an active strategy, because even if there's a turnover and profit churned out and booked immediately, he doesn't have to pay taxes. But the client which is taxable, to whom you would recommend a passive strategy. Okay, so that's one consideration. Second, transaction cost. Third, liquidity needs. So here are the pointers. This is something you should write. This can be tested in the morning section. Passive strategy is preferred when investors are taxable. Passive strategy is preferred when investor is taxable. Has an informational disadvantage. What does this mean? Active is used, oh no, not inside, not inside information. Yeah, he doesn't have access to information for some reason, and then there is no usage of active strategy in this case. Is investing in informationally efficient large cap markets. wants to avoid high transaction cost in small cap markets. And the last important point, very important from the morning section perspective, you write down first and then we will discuss what it means. Work on your writing speed, write faster. Vikram, Ruchi. Now, what is the last sentence? You can expect a question, something in the morning section, something which would be in the agree disagree category. Imagine an analyst makes a statement saying that active management is recommended for the client because historically it has been able to earn excess return, or it has been able to demonstrate better information ratio, and then they will ask you agree or disagree and then justify, and then of course you would say disagree and justification would be this particular sentence. Are you fine that this is a empirical data that active management has not been able to justify the higher cost which is spent on the research, and that's the reason why they have lower information ratio than semi-active. Are we fine? Their blogs, their blogs, there was an article, but same with the same conclusion. Yes. Which of the following situations an investor will prefer passive investment strategy? B. Taxable and efficient markets. Okay. Next point of discussion. Weighing schemes used in construction of equity indices and their biases. Okay. This is something you have already done in level 1, but we'll spend some time on this. I want you to make a flowchart with me. Now, a possibility of question tested on numerical is very, very less. Okay, but if you know how to deal with numerical, most of the theory would become relatively easier. So there are three possible weighing schemes. Number one is price weighted. Number two, equal weighted. And number three, market cap weighted. And there was one more variant which was, yes, free float market cap weighted. Do you remember this stuff? Price weighted, what do we assume? Yes, so you build a hypothetical portfolio where you say one stock of every constituent. That means whatever are the constituent securities, you will buy one stock each. So that automatically their price becomes their weight in the portfolio. In this case, yes, same amount in each of the constituent. And then this is Nothing but weight is the market cap. Okay, so from a level 3 exam perspective, what you need to know is what would be the biases in each of these indexes. Okay. Biases means what could go wrong in each of these indexes. So can you try to imagine what could go wrong in case of price weighted index? Let's do a numerical one, maybe just to revise the concept. Should I clear this off? Now, in your notes, leave some space so that you can write the biases right below this. So one flow chart will cover everything. Leave some space and come on to next page so we can do a numerical. Let us say we have stock A, B and C. We have prices at time 1, time 0 and time 1. Let us say price is 100, 150 and 200. Price 1 is 80, 180 and 240. The number of stocks, just to keep the calculations easy, I'm going to keep them as 5, 5 and 10. Calculate the value of price weighted, equal weighted and market cap weighted index at time 1 using a base of 100. Yeah, at time 1. Assume a base of 100. At least previous period index value was 100. 15, 14% लास्ट वाला आएगा ना, 11, 6 और 14. Should I do this now? See this, in case of price weighted, just one example, it should be fine. Price weighted, the weight are these prices. Okay, so total value of the portfolio was 350, 450 here, and value of the portfolio is, so this makes you 320, 400, 500. That means on an average, if you had one stock in the portfolio of all of them, the value of the portfolio has increased by 50 on 450. So that's about 11%. How much? 11.11%. So your price weighted index value would become 111.11. In case of equal weighted, you have invested same amount in each of the stock. So this value must have depreciated by 20%. This value appreciated by 20%. And this value appreciated by 20%. So the average is 20 divided by 3, which would be 6.66%. So value of the index now is 106.67. In case of market cap, we'll have to calculate market cap at time 0 and market cap at time 1. This was coming out to be 3250. 100 into 5, 500. This is 750, so 1250. And this is 2000, so this is 3250. And this value was coming out to be 3700. 500, 750, 1250. No, sorry. 400, 400. And 2400. This is 3200, right?
No. 400 plus 900.
This is 1300 and 2400, 3700. And then that would give us an increase of 13.84. So that's 113.84 is the index value. Easy? In equal weighted, we assume that weight of each of the stock is equal. In price weighted, we assume that we have purchased one stock of all the securities, and market cap, the weight is market capitalization. Okay. Now we will look at the biases. Now price weighted, do you remember we had to adjust the denominator for something? Yes, stock splits. I'll just show you a small example so that you get comfortable with this. Imagine we have three securities, A, B and C. The price of the security is 100, 200, let me round it off. So this is 300, let me make it another 300. Okay. Now what has happened is that there has been a split, and this stock has been split into 10 parts. So post split, now the value of this stock would be 100, 230. Okay. So how do we adjust the denominator? We take total of this 100 plus 200 plus 300 divided by 3. The average was how much? 200. Now instead of 30, we have 30. What should be the denominator in such a way that average should be 200? So that the ratio remains in equilibrium. This is how the adjustment is done to denominator. Are we fine? So again, you don't need to know the calculation. Just know that in a price weighted index, if there is a stock split, then we have to adjust the denominator. Yes, we have to still adjust the denominator. Price split or bonus, same impact. Yes, so the divisor of price weighted index is adjusted for stock split and changes in the composition of the index. Biases, higher price will have more impact on the index. As the stock price changes over time, representation in the index changes. It assumes one share of each stock, which is rarely used in real life. So these three biases write down in your flowchart. Here you can write it separately, whatever suits you. Make sure you remember at least one or two of them. Yes, Dow Jones is a price weighted index. Nikkei and Dow Jones, both of them price weighted. Yes, exactly same. Which one out of these three biases you seem, which seems to be most practical? No, no. Which of the biases you feel are really biases? Uh-huh. To me, I think the third one is, more. Second one doesn't make sense to me at all. It just I've listed it because it's there in the curriculum. As stock price change over time, its representation index will also change. So that's fine. I don't understand why it's a bias. See, it's a bias in a way because in real life, no one will build a portfolio like this. Have you seen any investor doing it? One one share of all stocks. So generally, it won't be used in real life. Okay, and yeah, this is fine. Higher price will have more impact. So with time, uh, if the price increases, weight will increase. Next one, value weighted index. We know what is a free float. Free float means the shares are not available with the public. Free float are the shares available. So, yeah, I'm sorry. So, in case, let's say, I think we've done example of Wipro many times in the past, that 25% of the shares are stuck with the promoters, 75% other way around, 75% is with the promoter, 25% is with the public. So then, if Wipro is one of the constituent, the number of shares that would be used would only be 25%. Okay. In curriculum, they have really good discussion on this, where they say that 25% are shares with the 25% shares are with the public. But even in that case, there would be a few investors who are not promoters. They will have 2%, 3% shareholding, which they will never sell. Okay, so in real life, the true meaning of free float is that even those should be excluded. But from a calculation perspective, it's very difficult to understand which are those shares. Okay, so we don't have to go too much in depth because that's not doesn't seem to be a testable area. We just know this. What are the biases now? Higher market cap will have higher weight, and this you would not find a mention in Schwezzes, that it kind of ends up using a momentum strategy. You write down, I'll explain you why. Do you understand what is a momentum strategy? Yes. Yes. So momentum would be, if the markets are rising and you're on a upscale, then keep on buying. If the markets are falling, then keep on selling. As against maybe a contrarian strategy where you sell when the markets are rising and buy when the markets are falling. Now what happens? Imagine you decide to build a value weighted index. Okay. So as the price of that stock will be increasing, that stock's weight in your portfolio would be increasing. As the price would be decreasing, that stock's weight in your portfolio would be decreasing. So in a way, you end up using a momentum strategy for your portfolio. Followed? Next one, equal weighted index biases. Can you tell me why does it favor small caps? You give equal weights. So L&T and maybe some small cap Kohinoor stock would have the same weight in the portfolio. Then higher transaction cost because
We have to regularly
yes, the most frequent rebalancing happens in equal weighted because you have to ensure that same amount is invested in every stock. And then liquidity issues. What if one of the stock is not liquid and it is lost in value, you want to buy more, and if it's not available in the market, so there could be liquidity issues in maintaining this kind of an index.
why favor small cap stock with the buy side? Is the good thing like they are kind of equally weighted?
See, this is good thing and bad thing both, isn't it? Because it is contradicting the earlier point. In case of a value weighted index, it favored the large cap. They said that was a bias. Now in this case, it favors a small cap, which is also a bias. You don't have to favor anyone in a way. No, not necessary. Contrarian investors exactly do the opposite way. So what they're saying is why bias? Even if I do not want to use that strategy, momentum strategy, if it's a value weighted index, I'll end up using it. So therefore, it's a bias, which is just one of the theory points to know it. All right then. So